Hello viewers and welcome to the channel. My name is Shannon Rivkin. The date is the 25th of March 2022. Question that we will be delving into today is, with the Nasdaq now up almost 10% from its recent lows, is the sell-off in tech now behind us? All right, a few things to show here. I've got the performance of the Nasdaq, S&P 500, which is obviously largely dominated by tech anyway, and the ASX 200, which is a very different index, largely dominated by financials and resources. And this is since at the beginning of last year, actually, to show how the rise in long-term bond yields, government bond yields, started to impact performance in growth names, and certainly earlier on in the year. And it's important to distinguish as well that while the S&P 500 and Nasdaq are dominated by tech, they're even more dominated by what you would consider, defensive tech, and that's, Apple, Alphabet, which is Google's parent, Amazon, and which one am I missing? And Microsoft. Meta, the old Facebook, was, would have included in that, but that they've obviously stumbled into their own issues. But that's really held up the Nasdaq, and it's kind of clouded what was a pretty significant sell-off in growth and tech, throughout pretty much the entire of 2021, actually. Or I think a few months into the year when bond yields start to kick up, you start to see that sell-off. And at that point, really, we've seen the ASX 200, or at least lately, kind of the falls have been far more shallow, and it's kind of held up relatively well. But of course, now we're just starting to see the outperformance in growth again in the last few weeks, and the question is, whether this will be sustained. I think this is obviously the very important chart to show when we're going to talk about this. US government bond yields since before the pandemic, and what's obviously incredible is that pre-pandemic bond yields were, if anything, going down. Inflation just wasn't a factor coming out of the GFC and the Euro debt crisis and all that. It was a period of low inflation, pretty restrained, although solid economic growth, and certainly downward pressure on interest rates. Whereas the current environment now is inflation's a huge issue, whether it's demand pull inflation or not. We'll see. We'll see, and obviously, when you listen to central bankers around the world, certainly it seems like they believe that their tightening monetary conditions will have a big impact on inflation. I probably subscribe to somewhere in the middle theory that a lot of this is either COVID pandemic related or Ukraine war related, and that once we see those start to disappear into the rearview mirror, the downward pressure on inflation will start to come, and won't necessarily be anything to do with softening demand caused by monetary policy. Anyway, but the whole point is we're seeing now bond yields ahead of where they were, and certainly trending that way as well pre-pandemic. So, with that in mind, knowing that long-term growth assets such as tech businesses, knowing that their long-term cash flows, their future cash flows are worth less in a higher interest rate environment, I think the sell-off in tech has been very appropriate. The question is, of course, whether now the worst has been seen. Now, what I've got here, this is a little bit hard to see. I've got trying to demonstrate the different performance in different parts of the market. I've got at the top part, you've got the Apple's, Microsoft, Amazon's, and Alphabet's, which really have been far less volatile. So I haven't seen anywhere near the sort of sell-off that really high quality names and household names such as Shopify, Salesforce, PayPal, and Block, which is Square, which were down 60-50%. And yeah, they're starting to bounce back, but still down, pretty significant levels. And it's really, you really need to keep your eye on the fact that the Nasdaq is being driven by the performance of the big boys such as Apple, Microsoft, Amazon, and Alphabet. And these trade on lower multiples. They are more defensive businesses. They, for the most part, have found that the pandemic has been if anything, a big tailwind for their businesses. I think Microsoft, which has great exposure to cloud computing, Amazon too, e-commerce and cloud computing, and Apple probably in its own category of just such an incredibly strong brand that and no, I should say they do have competition, obviously, and Google and the Android devices do offer a competition, but Apple's distinguished itself, and it's now building up its services business and seems a very defensive tech business. But again, not trading at the really high multiples that you see in these other software businesses. But I think where to from here, and this is a really important question. I think that we have seen a bottom in at least the dramatic sell-off, but I think if you're going to invest in tech now, you need to be very selective. I do think inflation is going to be a factor. You need to think about the tech businesses that have pricing power, can pass on some of the inflationary cost pressures that they're seeing onto their customers. And I should say, paying the right price is everything. The fact that, during the pandemic, software businesses started to trade at 60, 70, 80 times revenue multiples was, a sign of boom times or bubble times perhaps. And I think that rather than saying that these stocks have fallen 50, 60, 70%, therefore they're cheap, you need to say that should they have been trading at those levels in the first place? Probably not. So not every tech stock is the same. You need to pick the right ones. But I think the good news is that indiscriminate selling in the entire sector is probably now behind us, and now you can pick the best names and hopefully, if you pick the right ones with the right long-term tailwinds, you should start to see great performance going forward. Anyway, that's it for this week's video. Thanks for tuning in, and I will be back next week with a new video.